I want you to stop what you are doing right now and think about a single crucial number: $10,000. For many people, that number represents stability, the emergency fund, the first decent chunk of savings, or the capital reserved for a meaningful investment. It feels significant, yet in today's rapidly changing and increasingly volatile economic landscape, it also feels fragile, threatened, and perpetually insufficient. If you have $10,000 sitting in a savings account, a money market fund, or even a typical passive index fund, I need to tell you a fundamental truth, the kind of truth that the financial media actively avoids, that $10,000 is under immediate and relentless attack. The great danger right now is not a sudden market crash that drops its nominal value by 20%. The true, silent, devastating danger is that by the end of this decade, that $10,000 will buy you less than half of what it buys you today. It is being systematically vaporized by the most insidious thief known to history, the destruction of purchasing power, engineered not by criminals, but by central banks and fiscally irresponsible governments. This is not pessimism, it is arithmetic, and arithmetic, unlike financial prognostication, is rarely wrong. My focus today is not on complicated derivatives, opaque venture capital deals, or the latest fleeting craze in the digital asset space. My focus is on the philosophy of a man who has built an entire financial empire on understanding this exact threat. A man who has consistently stood outside the mainstream consensus, often alone, and been proven spectacularly right time and time again. Eric Sprott. We are going to dissect the simplest, yet most profoundly effective strategy that Eric Sprott advocates right now for growing a modest sum, that critical $10,000, in a world defined by monetary chaos and geopolitical instability. And critically, we are going to talk about doing it the safest way possible, which, in the Sprott lexicon, means avoiding paper promises and embracing physical, tangible reality. When most people hear safe investment, they immediately picture treasury bonds, certificates of deposit, or perhaps utility stocks, low volatility, low return. These instruments offer nominal safety. They guarantee that you will get your dollars back, but they guarantee nothing about what those dollars will be able to purchase when they return to you. In a world where the official inflation rate consistently understates the actual cost of living increases, the price of food, housing, energy, and education, you are not preserving wealth when you accept a 2% return on an asset that is losing 5, 6, or 7% of its purchasing power annually. You are systematically shrinking your future. Eric Sprott views the current system, the fiat currency system backed by nothing but faith and massive piles of debt, as fundamentally broken. His entire investment thesis for the last 20 years has been based on the inevitability of the reckoning that follows decades of excessive money printing, zero interest rate policy, or ZIRP, and quantitative easing, QE. When governments try to solve a debt problem by creating more currency, the currency itself becomes the casualty. It's an unavoidable law of economics, yet somehow it remains the great unlearned lesson of modern finance. So, the fundamental question we must address is this: how do we not only defend that $10,000 but position it for geometric growth, all while prioritizing the preservation of its real value? How do we find an asset that acts as a secure anchor against the raging storm of monetary debasement, yet still contains the potential for tenfold returns? The answer, if you have followed Sprott's career even casually, will not be surprising in its general class, but the specific implementation is where the genius and the safety lies. The answer is tangible, physical, and globally recognized as the ultimate store of value: precious metals, specifically gold and silver, leveraged through select, carefully chosen equity plays. Now, before you tune out, thinking you already know the gold and silver story, understand this. Sprott's approach is not simply buying a generic exchange-traded fund, ETF, that holds metal, or allocating 5% of your portfolio to a metals basket for diversification. That is the traditional, timid approach. Sprott's approach is concentrated, strategic, and rooted in a deep understanding of supply depletion and market leverage. Let's contextualize the conflict. We are living through an unprecedented period of credit expansion. Global debt levels are astronomical, and central banks are trapped. If they raise rates too high, they crash the banking system and the housing market. If they keep rates low, they guarantee runaway inflation. They are attempting to navigate a narrow corridor, and Sprott's long-standing view is that they will always choose the path of least immediate resistance, which means choosing currency debasement over a debt default crisis. They will sacrifice the saver for the debtor. This environment of negative real interest rates, where the interest rate you receive is lower than the actual rate of inflation, is the single most bullish condition possible for hard assets like gold and silver. Why? Because the opportunity cost of holding metal, which pays no yield, vanishes when paper assets, like cash or bonds, are guaranteed to lose value after inflation. Gold becomes an effective yield-bearing asset because its purchasing power is preserved while the purchasing power of its competitors erodes. But we are talking about turning $10,000 into a truly meaningful sum, not just protecting it from inflation. Gold is the ultimate insurance asset. It is the foundation. If you look at gold historically, it tends to rise proportionally with the money supply over the long run. If we want exponential returns, we need to focus on silver, and crucially, on the companies that are discovering and producing these metals. This is where the concept of leverage through equity comes into play, and this is the core differentiator in the Sprott strategy for generating massive returns safely. When you buy physical gold, the price must double for your $10,000 to become $20,000. That's a one-to-one relationship. When you buy a share in a high-quality, low-cost gold or silver mining company, you introduce exponential leverage. If the price of gold rises by 50%, the profits of a well-run miner can double or triple, because their costs, the expense of digging the metal out of the ground, remain relatively fixed. This profit explosion is the mechanism by which Sprott achieves the growth component of the investment thesis. But there is a specific, often overlooked segment of this market where the leverage is highest, and where Sprott often focuses the most acute capital, the junior miners and exploration companies. These are not the giant, sluggish behemoths like Barrick or Newmont. These are the small, nimble companies trading sometimes for pennies or a few dollars, sitting on a high-quality deposit, a potential mine, that hasn't yet been fully developed or even fully appraised. This is where the risk is managed, paradoxically, by focusing on geological quality and jurisdiction stability rather than market sentiment. For the purpose of our $10,000 growth strategy, Sprott's philosophy dictates that you must be willing to accept short-term volatility in exchange for the long-term, asymmetric upside potential that these smaller companies provide. If a junior miner starts trading at 50 cents, and then, after successful drilling and a feasibility study, a major mining company decides they want to buy that deposit, the stock price can quickly move to $4 or $5. This is known as optionality. You are buying the option to participate in a major discovery at an incredibly low price. The safety in this high-leverage segment comes from a specific analytical approach, which we must adopt entirely. We are not gambling on poor-quality deposits in unstable regions. The Sprott method emphasizes jurisdictional safety, companies operating in Canada, Australia, and the U.S., and focusing only on deposits with proven high-grade resources that are currently undervalued by the broader market. When you stick to quality assets in safe locales, you reduce the primary risks associated with mining, geopolitical turmoil, regulatory changes, and poor geology, leaving only the risk of market timing. Let's bring this back to the $10,000. If you allocate that capital to a diversified portfolio of traditional assets, you are almost guaranteed a negative real return. If you allocate that capital, following the Sprott philosophy, into a tightly focused basket of high-quality junior resource stocks, particularly those heavily weighted toward silver, you position yourself to capture the coming tidal wave of monetary inflation. Why the heavy focus on silver, specifically? While gold is the monetary king, silver is the industrial workhorse that also retains monetary status. Silver has a much smaller market capitalization than gold, meaning that even a small inflow of capital from institutional investors can cause its price to spike dramatically. Furthermore, the supply-demand picture for silver is significantly tighter due to its extensive use in solar panels, the green energy transition, and high-tech manufacturing. Unlike gold, which is mostly hoarded, silver is consumed, leading to persistent supply deficits. This structural imbalance means that the leverage inherent in silver miners is even greater than in gold miners. If gold moves up 100%, silver has historically moved up 150% to 200%. If the underlying metal moves 200%, a high-quality silver miner might move 500% to 1,000%. That is the mechanism for turning $10,000 into $100,000 or more, while relying on the safest possible fundamental principle, the preservation of real capital through ownership of assets that cannot be printed by government decree. The key distinction here, which is the crux of the Sprott methodology, is understanding the difference between price and value. Right now, the price of gold and silver equities is profoundly disconnected from their underlying value, due to years of investor apathy and focus on cryptocurrencies and high-growth tech stocks. This provides a temporary window for investors with modest capital like our $10,000 to enter positions that larger, slower institutions often cannot exploit effectively. This strategy is not about chasing the fastest return. It's about identifying the most mispriced, essential assets in the global economy and holding them until the inevitable recognition occurs. The safety comes from the fact that even if the market lags for several years, you are holding a claim on physical metal in the ground, an asset that retains value regardless of the stock market ticker. We have established the foundation. The economic environment is hostile to fiat currency, necessitating a shift to hard assets. We have established the thesis, safety through physical metal ownership, enhanced by the geometric growth potential found only in high-quality, undervalued junior resource equities, especially those focused on silver. But the devil, as always, is in the details of execution. It is one thing to say, buy junior miners, and quite another to select the precise companies that meet Sprott's rigorous criteria for geological grade, management competence, and balance sheet strength. How do we filter the hundreds of risky, speculative ventures down to the handful of quality, safe, high-leverage plays that could potentially transform that $10,000 into a generational stake? That is the indispensable next step. The success of this strategy hinges entirely on separating the genuine, safe opportunity from the mere speculation. In the subsequent part of this discussion, we will drill down into the practical mechanics, analyzing the specific financial ratios and geological indicators that Eric Sprott uses to screen for these high-potential, yet fundamentally safe resource companies. We must move beyond philosophy and into actionable intelligence, determining exactly where, within this vast and often murky sector, one should deploy capital today to secure both preservation and profound growth. The urgency that permeates our current financial landscape is not a vague feeling. It is a measurable decline in purchasing power, accelerated by policies that treat money creation as a consequence-free solution to structural debt problems. If we started this conversation with the idea of simply preserving $10,000, we quickly realize that preservation is a losing game against inflation, running at true rates far exceeding official figures. Our goal must shift from simply holding value to actively growing it, and doing so through vehicles that are fundamentally insulated from the very systems that are causing the erosion. This brings us back to the core mechanism Eric Sprott and his cohort have mastered, the strategic leverage found in the mining ecosystem. We established that physical gold and silver are the bedrock. They are the insurance policy. But insurance policies only maintain your status quo. They don't grant you the outsized growth necessary to overcome years of lost returns and aggressive currency debasement. To turn that $10,000 into a truly meaningful, inflation-adjusted larger sum, we must apply intelligent leverage, and the purest, safest form of leverage in the precious metals sphere is not options, futures, or margin trading. It is the equity of the companies that discover and extract the metal itself. This is the essential pivot point in the Sprott strategy, the second hook, if you will. The recognition that the miners, the GDX, the GDXJ, and specifically the carefully selected junior exploration plays are deeply, historically undervalued relative to the physical commodity they produce. Why does this disconnect exist? Why, when gold has maintained a high plateau around the $2,000 mark, are the mining companies not yet pricing in the massive cash flows they are realizing? The conflict here is a classic market inefficiency driven by liquidity preferences and institutional memory. Following the massive bear market in commodities that stretched from 2013 through 2018, generalist investors abandoned the sector entirely. Mining became a dirty word, associated with capital destruction and cyclical collapses. Institutional memory is long, and large funds, which operate on relative performance metrics, simply refuse to allocate meaningful capital back into this sector until the momentum is undeniable. This creates a spectacular opportunity for the disciplined, contrarian investor, willing to accept short-term volatility for massive long-term asymmetry. Consider the basic economics of a mining company. Their primary cost structure, labor, fuel, capital expenditures for machinery, and processing costs, while they do rise with inflation, are relatively stable compared to the dramatic movement in their revenue source, the price of gold. When a senior gold producer has an all-in sustaining cost, or AISC, of $2,300 per ounce, and gold is trading at $1,800, their profit margin is $500. Now imagine gold moves up by only 20% to $2,160. Assuming their AISC only moves up marginally to $1,350, their new profit margin is $810. A 20% increase in the metal price results in a nearly 60% increase in the profit margin. This is operational leverage in its most powerful form. But even this substantial leverage found in the established senior producers often isn't enough to deliver the multiples necessary for aggressive growth, starting from a small base like $10,000. To hit 10 times or even 5 times growth in a volatile but finite time frame, we must look further down the risk curve, focusing precisely where Sprott directs the majority of his high-conviction capital, the junior and developmental exploration companies. This takes us deep into the commodity cycle thesis, a necessary foundation for understanding the present asymmetry. Sprott operates based on the understanding of the long kitchen cycle, which dictates that commodities run in multi-decade supercycles, punctuated by shorter investment cycles. We have just emerged from a multi-year commodity depression driven by extreme underinvestment. This underinvestment is the most critical variable right now. Think about the physical realities of the mining business. You cannot simply decide today to ramp up gold production next month. It takes on average 10 to 15 years from the initial discovery hole to the first pour of commercial gold. Because the price of gold plummeted after 2011 and remained low for many years, companies slashed their exploration budgets to conserve cash. The pipeline of new discoveries, the future supply sources of gold and silver, went dry. There are simply far fewer major economic gold deposits discovered today than there were a decade ago. We are now entering a period of structural scarcity driven by geological reality and past capital starvation. This structural scarcity means that the cost to find and delineate a new ounce of gold is rising exponentially, and critically, the major producers, the Newmonts and the Barricks, are literally running out of reserves. They are mining faster than they are replacing. What happens when a multi-billion-dollar company finds its reserve life dwindling? They cannot wait 15 years for their own exploration efforts. They must acquire companies that already have discovered deposits. They must buy the assets of the junior miners. This is the open loop that connects the macroeconomic collapse to the micro-investment opportunity. The juniors are currently trading, often far below the cost of the metal they have already proven exists in the ground, the in situ value. They are suffering from the same generalized investor apathy. But as the structural supply crunch tightens, as inflation pushes the gold price higher, and as the majors become desperate for replacement ounces, the price they are willing to pay for a proven junior discovery skyrockets. This is the true asymmetric bet. A senior miner might move 30% if gold moves 15%. A small junior exploration company, currently valued at perhaps $50 million, that successfully publishes a world-class preliminary economic assessment, proving up 3 million ounces of high-grade gold, instantly becomes a takeover target. Its valuation is not tied to the price of gold moving from $2,000 to $2,100. Its valuation is tied to the price a major producer will pay to secure its future reserves. That jump can be 200%, 500%, or even 1,000% in a single calendar year. This mechanism is why the Sprott strategy is fundamentally sound for aggressive, safe growth. It involves participating in the necessary consolidation and replacement cycle of a physically constrained commodity market. Safety, in this context, is defined by the underlying commodity being counter-cyclical to the collapsing fiat system, and the investment being positioned at the point of maximum operational and geological leverage. But we must insert a crucial pattern interrupt here. The junior mining sector is often referred to as the lottery, and for good reason. For every company that hits a world-class discovery, there are dozens that drill dry holes or fail due to poor management, remote logistics, or political risk. This volatility is precisely why most retail investors fail in this sector. They lack the technical expertise to filter the junk. This is where the specialized knowledge of Sprott and his geological team becomes irreplaceable. They are not simply buying the index. They are conducting deep fundamental due diligence. Their investment philosophy focuses on specific tangible filters: jurisdiction risk, preferring stable regions like Canada, Australia, or the US, management track record, backing proven geological teams who have discovered and sold mines before, and most importantly, proximity to existing infrastructure or known deposits. They seek juniors that have already demonstrated strong drill intercepts, moving them from high-risk exploration into the resource definition phase. The game is not to buy 500 different juniors and hope one pays off. The Sprott method is about intensely concentrating capital into a small handful of companies that have a statistically high probability of being acquired at a premium, because their assets are essential for the survival of the senior producers. This laser focus significantly mitigates the typical risks associated with the junior sector. Let's circle back to the central problem: the diminishing liquidity in the broader financial markets. As central banks begin to lose control, or perhaps begin to admit they have lost control, and the confidence in the fiat currency structure wavers, money will desperately seek safety. That safety will be found first in physical metals, causing prices to soar. But crucially, as the majors find their cost of capital increasing and their need for reserves intensifying, the bids for quality junior assets will become frantic. Right now, many high-quality junior mining stocks trade barely above their exploration expenses. This is the opportunity window. It is based on the idea that the market is currently mispricing future desperation. The market is liquid enough today that these smaller companies can still be acquired cheaply by the investor. But as the narrative shifts, as the masses realize that the fiat experiment is truly terminal, capital will flow in, and the prices of these leveraged vehicles will become unattainable. The safety in this high-risk sector is derived from the absolute necessity of the product. Fiat currencies can be printed infinitely. High-grade gold deposits cannot. The leverage is safe because it is based on the immutable laws of supply, demand, and geology, not on financial engineering or central bank promises. When you invest in a quality junior miner, you are investing in an asset that, regardless of how high inflation goes, will always be worth something to a major producer, desperate to replace its depleting inventory. The question then shifts from which sector to choose to how to deploy the capital most effectively within this sector. We need a hierarchy of safety and leverage. The senior miners, GDX, provide foundational safety and solid operational leverage, the 60% profit boost we discussed. The intermediate producers and developers, GDXJ, provide greater leverage but with slightly higher execution risk. But the real magic for the $10,000 investor lies in the pure exploration plays, the companies that are pre-production and focused solely on proving up reserves. These are the companies Sprott often allocates significant amounts of personal and fund capital to via private placements, a strategy that allows him to acquire shares at a discount and often receive warrants, further multiplying the potential return. For the retail investor, accessing these exact private placements is challenging, but we can replicate the philosophy. We look for the juniors that Sprott and other smart money managers are already heavily invested in. This acts as a powerful due diligence filter. If the capital of one of the world's most successful contrarian metal investors is sitting on the cap table, the geological and management risk is already heavily discounted. To successfully grow that initial $10,000, we must therefore accept that volatility is not the enemy. Volatility is the price of the asymmetric opportunity. We must view any short-term dips in the minor equities not as losses, but as moments to accumulate more ounces of future revenue. We are trading the illusion of stability in fiat accounts for the real, tangible growth driven by operational leverage within an essential commodity sector. The deeper we dig into the macro environment, the unsustainable national debts, the velocity of money, the political incentive to inflate away obligations, the clearer it becomes that the leverage afforded by the miners is not reckless. It is a defensive necessity. It is the only way to ensure that $10,000 today will translate into purchasing power that truly matters tomorrow. But this brings us to the final, necessary piece of the puzzle, the one we have only hinted at, the mechanism of liquidity and the ultimate exit strategy. When the panic truly sets in, when the commodity supercycle enters its mania phase, the challenge shifts from identifying the winners to maximizing the payoff before the inevitable correction. Sprott understands that the greatest risk in the junior sector isn't missing a discovery, it's being caught holding paper assets when the global financial system seizes up due to lack of trust and liquidity. Therefore, the safest way to grow $10,000 requires not just the right equities but a built-in mechanism for translating those gains into ultimate physical security. We must discuss not only the best junior picks but the tactical deployment of warrants and the crucial, often overlooked necessity of holding a specific precious metal asset that acts as the final buffer against systemic collapse, securing the gains before the music stops completely. This final layer of protection is what separates the astute investor from the one who merely chased a trend. I want you to stop and take a deep breath. For the last two segments, we have meticulously built the foundation, charting the course of the global economy toward an inflationary reckoning, driven by unprecedented debt accumulation and the inevitable devaluation of fiat currencies. We established the fundamental principle. The safest way to grow $10,000 today is first to ensure that $10,000 retains its purchasing power tomorrow. We've acknowledged that the consensus is wrong, that the perceived safety of government bonds and tech megacaps is an illusion built on the quicksand of central bank liquidity. Now, we arrive at the critical juncture. This is where theory must translate into definitive action. This is the moment of maximum clarity, the culmination of the Sprott philosophy, designed not just for preservation, but for explosive asymmetric growth. If you have stayed with me this far, you are no longer interested in conventional investment wisdom. You are looking for a definitive advantage. And that advantage, the purest expression of financial prudence in this unstable era, lies in the leverage derived from carefully selected hard asset equities, specifically those involved in the extraction of monetary metals. Let me be perfectly clear. Holding physical gold and silver is the bedrock. It is the insurance policy. If your goal was purely survival, physical bullion would suffice. But our objective is not merely to survive the coming storm, it is to aggressively grow that initial $10,000. To do that, we must introduce intelligent leverage, the kind that multiplies your returns without relying on margin calls or excessive debt. The most profound inherent leverage available to the retail investor today is found within the mining sector. Think about the economics of a mining company for a moment. They have fixed costs, the cost of building the mine, the cost of labor, the cost of energy to extract the ore, and so on. Let's assume, for simplicity, that a quality silver miner has an all-in sustaining cost, or AISC, of 18 per ounce. If silver is trading at $20, they make a modest profit of $2 per ounce. This is a respectable, if unexciting, business. Now imagine the scenario that Sprott and his team foresee. Massive monetary inflation drives the price of silver, not to $25, but to $50, $75, or even $100 an ounce, driven by true industrial demand meeting panicked investor flight from fiat currency. What happens to that miner whose costs remain relatively stable at $18? At $50 silver, their profit is now $32 per ounce. The price of the underlying commodity, silver, has risen by 150%, from $20 to $50. but the profit per ounce has exploded by 2,600%, from $2 to $32. This is operational leverage, and it is the key to turning a modest $10,000 allocation into a life-changing sum. The stock price of that miner, which is valued based on its expected cash flow and profit margins, will not merely track the metal price. It will amplify it exponentially. Historically, in previous bull markets for precious metals, the shares of quality mining companies have outperformed the underlying metal by factors of 3, 5, and even 10 times. This inherent leverage is why we focus on equities, but not just any equities. The industry is fraught with pitfalls: incompetent management, poor geological surveys, political instability, and massive cost overruns. This is where the wisdom of the experienced, dedicated, and specialized fund manager, the Eric Sprott type of insight, becomes indispensable. For your $10,000 allocation, which requires precision and maximized opportunity, you must adhere to a strict set of criteria that filters out the noise and focuses only on the jewels. First, jurisdictional safety and quality reserves. We are seeking assets in politically stable jurisdictions, places where property rights are respected and the risk of nationalization or punitive taxation is minimal. This rules out vast portions of the globe, focusing our searchlight on safer havens. Moreover, the reserves must be high-grade and substantial. We are not interested in speculative exploration plays that require decades of funding and regulatory battles. We are interested in producers or near-term producers with defined, high-margin, profitable ounces in the ground right now. Second, management track record and alignment. The management team must have a proven history of developing mines efficiently, and critically, they must have significant skin in the game. When a CEO is heavily invested in the company's stock, their interests align directly with yours. They are working for their own fortunes and, by extension, for yours. This alignment is non-negotiable. Many companies are run by individuals focused on maximizing their own salaries and perks, rather than shareholder value. We avoid those like the plague. Third, undervaluation relative to the gold price. This is the critical filter. Right now, due to market pessimism and the historical aversion to the cyclical nature of mining, many excellent companies are trading at deep discounts, valuing their assets based on today's depressed metal prices, or even lower. We are looking for companies that, based on a reasonable forecast of $3,000 gold or $50 silver, which, given the fiscal environment, is a matter of when, not if, appear profoundly undervalued today. The gap between the current stock price and its intrinsic value in an inflationary environment is your margin of safety and your engine for growth. Let's return to the $10,000 investor. You might think that $10,000 is too small to make a difference in the mining world. That is precisely the misconception that keeps people poor. $10,000 deployed with surgical precision into a basket of 3 to 5 carefully vetted, high-quality royalty, producer, or developer companies, the types that Sprott himself is known to favor, can achieve extraordinary compounding. If your chosen basket of equities averages a 500% return in the next 3 to 5 years, a conservative estimate compared to previous gold bull markets, that $10,000 becomes $60,000. Now, imagine if that $10,000 was invested in a general S&P 500 index fund, which will be fighting inflation, rising interest rates, and the subsequent margin compression that follows excessive debt. Even a robust 50% gain in the index would only yield $15,000, and the purchasing power of that $15,000 would likely be substantially eroded by inflation. The point is clear. Safety is achieved not by avoiding risk entirely, but by taking asymmetric risk, where the potential upside is vastly greater than the defined downside. The downside risk in a quality mining company is usually its operational failure or a catastrophic drop in metal prices, an event highly unlikely in our current inflationary paradigm. The upside, however, is limitless cash flow growth as the commodity price escalates. We are standing at the precipice of the final, most violent stage of this economic cycle. The central banks are attempting a controlled demolition of the currency, believing they can manage the process. History shows this never ends neatly. When the inevitable panic sets in, liquidity will rush into the safe havens, and because the gold and silver mining sector is currently so small, so underowned, and so despised by generalist investors, the capital inflow will disproportionately affect prices. This dynamic creates a profound opportunity that is fleeting. Why? Because once the metals break out definitively, say gold holds firmly above $2,500 and silver sustains $30, the generalists will begin to return. Once they return, the extraordinary leverage and undervaluation we currently enjoy will vanish. The prices of these select equities will reflect their true potential cash flow, and the massive asymmetry will be gone. This is the very essence of Sprott's strategy, accumulating quality assets while they are cheap, unpopular, and undervalued before the macro forces make them mandatory. Consider the role of silver in this equation. Gold is the conservative play. It holds purchasing power reliably. Silver, however, is gold's little brother with a caffeine addiction. It is both a monetary metal and a critical industrial commodity, used extensively in solar power, electronics, and electric vehicles. When the market realizes that inflation is structural and not transient, the monetary demand for silver explodes. Simultaneously, the green energy transition drives industrial demand through the roof. This twin tailwind means that the operational leverage of silver miners is often even greater than that of gold miners. For the investor seeking maximum growth on a smaller capital base like $10,000, a healthy strategic weighting towards high-quality silver producers and developers is often advisable. They provide the turbocharge needed for significant multiplication. Let's address the final piece of the puzzle, the emotional commitment required. This strategy demands patience and conviction. The market will test you. There will be corrections. There will be periods of disheartening sideways trading. During these times, the broader market might appear more exciting. This is when you must refer back to the fundamentals we have discussed. The debt is still growing. The printing presses are still warm. The political imperative to inflate away the debt remains the primary economic driver globally. As long as these macro factors remain, your thesis for hard assets and the equities that extract them remains fundamentally intact. Eric Sprott's success stems from his unwavering belief in this macro thesis and his discipline in adhering to the criteria we've outlined. He is not driven by quarterly earnings reports or transient media narratives. He is driven by the structural reality of monetary policy and supply-demand dynamics for real assets. Your $10,000 is not just a number. It is a finite resource representing effort and time. To treat it safely means putting it in a place where reckless government policy cannot erode its value. To grow it means positioning it directly in the path of the inevitable capital flow when the panic finally sets in. The safest way to grow $10,000 right now is to stop participating in the consensus trade of paper assets that rely on central bank solvency. It is to move those funds immediately into a concentrated portfolio of world-class, high-margin, prudently managed precious metals equities, focusing on those companies trading at steep discounts to their future cash flow potential in a high-inflation environment. This is the conclusion. This is the definitive answer. The evidence is overwhelming, the historical precedents are clear, and the window of opportunity is narrowing rapidly. Waiting for confirmation, waiting for the mainstream financial news to trumpet the return of the gold bull market, is waiting too long. By that time, the immense leverage you can acquire today will be gone. You must research. You must identify those producers and developers that meet the Sprott criteria, the low-cost leaders, the high-grade reserve holders, the proven management teams. The time for deliberation is over. The time for calculated, aggressive action has arrived. Secure your capital, gain the leverage, and position your $10,000 for the growth phase that only hard assets can provide in the face of currency destruction. The journey to meaningful financial security starts with this non-consensus choice, executed with disciplined conviction. Do not delay. Research and deploy now.